Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. Today we want to continue with our series on advanced financial management, and currently we want to start a new topic that we introduced in our previous video. Of course, I told you that we are going to start on a topic called capital structure and dividend policy. So the topic is capital structure and dividend policy. So I want to start with something to build up with what we covered in the previous video. We agreed that capital structure, in the previous videos, we agreed that capital structure is actually a mixture of sources of funds a firm uses. This is a mixture of funds a firm uses, and we said it could be debt. And when we talked about debt, we looked at bonds, we looked at bonds or debentures, we looked at term loans, and we also included things to do with preference shares. We say that preference share is debt from the legal point of view. We also said it could be debt or it could be equity. So in a business, you can be using debt, a mixture of both debt and equity items. So with equity, we said it could be common stock. That's what we call OD, ordinary shares. These are ordinary shares. It could be retained earnings. Of course, most of the times these are the two that form what we call the equity. So in your capital structure, or the mixture of different sources, it could be debt or equity. And you may find that in your capital structure, you have all of these items within your capital structure. Now, what we need to understand is the fact that if a company has both debt and equity in its capital structure, so the amount of debt items or debt component that we have in our capital structure, or the amount of debt the firm uses to finance its assets, is what we call leverage, financial leverage. So if we are using debt in your capital structure, we say that there is leverage, or what we call gearing. Gearing and leverage, they mean the same thing. So once in an organization you have debt in your capital structure, then we can say you are geared. Now, if you have a lot of debt, you have a component of debt finance in your capital structure, we say you are geared. Now, the moment that you have a higher debt in your capital structure, then we can conclude that you are highly geared. So once you have more debt in your capital structure than the equity, then we can say you are highly geared. So a company is said to be highly geared if at all their debt outweighs or is greater than the equity, meaning that the debt component outweighs the equity component. So there are arguments as to whether the company should have debt in their capital structure. Others think that it would be fine for a company to have 100% debt to be financed by 100% debt, or to be financed by 100% equity. Others think that we should have a combination of debt and equity in our financial structure. Now, there are different reasons, there are different advantages, there are different disadvantages of you having debt in your capital structure and having, let's say, equity. You can be totally having equity in your capital structure, meaning you don't have any debt. You don't use debt to finance your assets, or you may be 100% using debt. Of course, you can't be 100% using debt, because once you start a business, you can't start a business by just borrowing the money that you are starting with. At least there is something that you must have started with as the owner of the business. Maybe you had a building and you said, okay, let me just borrow money and I use that money to finance the operation, but at least I have the building. So the building will come as an equity or your own personal contribution. So the argument, though, is not as to whether someone should actually have debt in their capital structure or shouldn't. The argument is that the company, if it has more debt, in other words, if the company is highly geared, then it raises some concerns. Of course, we are not saying that the company which is highly geared can't exist. It can exist and it can be performing very well, but it has concerns to do with the takeover, because at some point, if the business fails to pay, then it has a risk of being sold out or taken out by those that gave that business the money. So we need to understand the argument of debt versus equity financing. In other words, for us to be having two things in our capital structure, I know we talked about a little bit about the, of course, having debt and having everything in your capital structure. We are just going to look at something small briefly, just to loop up what we discussed in the previous videos. But I want us to now concentrate on debt versus debt, of course, debt finance versus equity financing. In other words, we are still looking at the arguments of us having both debt and equity in our capital structure, having them at the same time. What is the argument behind it? Would it be good for you to have more debt than equity, or would it be fair for you to have equity more than your debt? So we are kind of taking something to do with kind of comparing what should be the idea. So financing a business through borrowing, of course, when you are borrowing, that's debt. Financing a business through borrowing is cheaper than using equity. Why? Why am I saying so? Why am I saying that financing a business using borrowing is cheaper? Because of these other reasons that I'm going to give out. Now, one of the reasons is the fact that lenders require a lower rate of return as opposed to ordinary shares. As opposed to ordinary shares. In other words, as opposed to equity finance. Because what do we mean by this? Now, you know that the shareholders, of course, these are the ordinary shareholders. Now, you know that the shareholders will need everything that the company has made. But if you are the lender, you are the bank, if you had suggested that you are going to pay us 10%, it will be 10% even if the company makes 200% profit. It will always be 10% because that's what you agreed to pay as the interest for the money they have used in the production of that income they have earned. But what happens to the side of the shareholders? For the shareholders, whatever the business has made, whether they put in 100 million and now the profit is 1 billion, they will be claiming on the whole 2 billion. But if the lender gave you 100 million and you are supposed to pay 10% or 2% or 10%, whichever the interest rate that you agreed on, and they gave you 100 million. So it would mean that on the 100 million that you paid to them, even if you have made a profit of 1 billion, you will still pay 110 million. You pay the principal plus the interest, if at all you are going to be paying it in 1 year. So that's why it is cheaper for you to finance a business using borrowed money than equity. Because a lender require a lower rate of return as opposed to the shareholders. The other is the fact that the transaction costs of securing debt are always minimal. The transaction cost of securing debt are quite cheap, are quite minimal. They are minimal in a sense that if you go to acquire a loan, what will happen? The banker will tell you that maybe for us, we charge, let's say, 3% processing fee. And they tell you on top of the processing fee, we are going to charge you stamp duty of let's say 50,000 Uganda shillings. And on top of that, we are going to charge you application fee of let's say 20,000. And that's it. But once you go to borrow money from equity, or if you issue out shares to the public, first of all, you have to hire experts. You are not going to do it alone. You will have to get lawyers who are going to be able to draft for you those different documentation that are needed. You are going to get the people, you are going to incur marketing costs, selling, making sure that you get people to know that you are actually issuing out shares so that they can be able to come and buy. There are other processes that you are going to go through for you to actually issue out those shares. So once it is going to be equity, then you are going to be incurring a lot of costs in regards to trying to get equity money. But for loans, the lenders are always straightforward. We charge you 2% or 1% process fee. or transaction costs, that you find yourself the costs are very minimal, and it even saving time for you to actually be able to get the money out of it. The other is the fact that the interest is tax deductible. The other point that I can talk about is the fact that interest is a tax deductible. Interest being tax deductible means that the taxman allows you to expense interest as an allowable expense before you charge tax. The whole idea is the fact that you are going to be paying less taxes because of you reducing your profit that you have made for a given period by the interest figure or the interest expense that you have incurred for using borrowed money in the production and supply of those whatever goods or services that you are rendering to your customers, which is not the case as for dividends. You know, dividends are paid out after getting the profit after tax. That's when dividend is not an expense. It is more like an appropriation of the profit that you have made. So that's why we are saying that borrowing from the lenders or using debt in the capital structure is more cheaper than taking equity. Of course, there are disadvantages that give, like the fact that the other advantage that you can talk about, there is no delusion of control. So delusion of control is the fact that when you bring in shareholders, these shareholders are actually going to come in and they affect how the management is going to run or how things are supposed to be done within the organization. And they do that through their annual general meeting where they can dictate what is supposed to be done. But for the lenders, when they give you money, it's up to you. As long as you can be able to pay the money that they have given to you with their interest, you are good to go. They have no problem with whatever kind of business. They don't interfere in the operations. Whether you invest the money in a very risky area, as long as you can pay them back, they have no problem. But as I said, there are disadvantages of you using debts. One of them, you could talk about the fact that some people may actually fear that their company may be taken out because of, I guess, if you don't pay the interest will keep on accumulating. And once it keeps on accumulating, it can threaten the going concern of the business because you can end up liquidating the business to be able to pay off these people, because interest is supposed to be paid. It's not like dividend. For the dividend, you can choose to pay or not to pay, or you can even change and say, I'm going to pay you paper money. Maybe I'm just going to increase your shareholding, but depending on the money that you have made as a business. So that's kind of something that I wanted to reflect on before we go into what we call the capital market theory, the capital structure theories and other kind of stuff. The other thing that I feel it's really important for us to look at it, even if we just give a highlight, are the determinants of the firm's optimal capital structure. When I talk about the word, let me first write it, determinants of the firm's optimal capital structure. Now, when I talk about the optimal, the word optimal means something that is a little bit moderate, something that you see, you can look at it and you say, okay, it's enough. It's not too much, it's not too small. It's in between there. It's just enough. So what do we mean by the determinants of the firm's optimal capital structure? We want to look at what is that good composition of you having debt and equity. What is the optimal level that I should have, let's say 50% debt and then 50% equity, or I should be having a 40% equity or a 60% debt. What determines, or what factors can we look at and say that based on this we should actually have this, so that we can be able to have or to moderate? Because as a business you don't want to have, as I said, you can't start a business honestly from the money that you have. Everything that you have is borrowed money. Like you don't have anything. Oh, I know you can start it, but especially maybe when don't actually have anything, but it's kind of something that you need to look at, especially when you start operating. You see how quickly can you be able to bring in something that is not equity, because that is not debt, because debt gives higher chances of you losing your business. So we want to look at what are those factors that are helping you determine an optimal capital structure. So the optimal here means that the company, you may find that the companies may be trying to balance between debt and equity. So you are trying to have a balance. You don't want to look like you are too into debt or you are too much into equity, because if you have too much money in terms of equity, you may not actually even think of what can I do with the money that I have, because we've seen situations like when we talked about things to do with overcapitalization, things to do with overtrading. We looked at where situations where someone, like especially for overcapitalization, where someone has so much money that, or they have very many assets, but they don't yield. If you look at the profit that they are making, it doesn't yield much. Like they have a lot of resources. It's like when you have very qualified employees, but you look at what they are doing and you'll be like, wait a minute, what are these guys doing based on their qualifications are okay, but when it comes to maybe in terms of execution or in terms of what they are doing, actually convincing customers maybe to have very many customers on board, it's a problem. So that's, you don't want to have such kind of stuff, and you don't want to be at the extent where you are lacking, completely lacking. You don't want to go into borrow. You are so conservative that you just prefer to use the money that you have. You don't want to go in for debt, fearing that the company may actually go, or you may lose your business. But everything is just about risk. But as long as you take calculated risks, has no problem. And that's why we are trying to balance, to have either to have debt or to have less, depending on the kind of situation. So what are some of the factors? Number one, we can talk about the tax deductibility. These are some points, but the way you phrase them. Tax deductibility of interest. You see, as I told you, interest is a tax deductible. So once it is deductible, someone may use that as an advantage because you are benefiting. If I'm allowed to expense interest, then I'm going to, of course, make myself have debt in my capital structure so that I can expense and I pay less in taxes. But it doesn't necessarily mean that I'm going to actually have so much debt. So it depends on how much you want to save as far as interest being deducted before you charge the tax on the profits that you have made. So if you don't want to have any kind of saving, you know, we companies do some tax planning and all other stuff. So these are some of the ways where you can actually save. If you look at if you want to go deep into what we call the tax planning, we have losses. If you look at the different countries give what we call, they give you a relief. Of course, you can't pay tax when you're making a loss. And to some countries like Uganda, taxes, those losses can actually be transferred. They can transfer up to 3 years. Of course, you learn that when you do your advanced advanced taxation or taxation paper. But those are some of the kind of things that you look at and you try to plan, because if you are going to have these expenses that are going to be allowed to you as a business, it is a saving to the business. So the tax deductibility of interest. Remember, we say that we are always allowed interest. We are always allowed interest to be expensed before we charge tax. So it's important, and it's one of the reasons why people are going in for debt to actually enjoy that benefit. The other point that we can talk about is what we call financial risks. So people fear risks. Of course, financial risks comes as a result of being geared. So it can determine if the risk is too much, people can say, let me ledger it. And I don't go into debt, but I use some maybe 50-50. I go, oh, maybe I have 30% debt and 70% equity. So that I know even if I lose this 30%, I can actually still have of course, you get the other 70, you still have the other 70, you pay off the 30%, you remain with the 40% as your capital. So the level of financial risks. So this is just basically the risks that are associated with your capital structure by mere fact of having debt in the capital structure. So and I want to be a little bit flexible, that the way you explain this, the way you give these points, the answers are the same, but the way you explain them, it is just a matter of understanding what you're doing. We saw this number, actually some of these are examinable numbers. Don't take them for granted. We saw May or June, May/June 2022. We saw a question. It was about the factors that influence a company's capital structure. Of course, they are the same determinants that I'm talking about here, though the way you explain them may be a little bit differing, because this is just looking at the optimal. But the other one, the question was basically on the factors that influence a company's capital structure. They don't talk about optimal amount of debt and equity, but for them they just wanted the general thing. But they are the same points. They are the same points that you could give out. The other, of course, we have also these business risks. There are risks associated with just having capital. There are other business risks like operational risks that are going to be associated with. So even the growth of the company can determine, because the growth rate of the company, if my company is all that, maybe, of course, if the company is already a grown-up company, some individuals may prefer to have more of their own money than struggling to be working for people, paying the interest and all that. But if the company is just starting to grow, the level of growth is not all that. You always want to perform. Given the fact that you have debt in your capital structure, you'll find ways of how to make this business grow so that you can be able to pay the loan that you took. So even the management style, you can get the management style. You can get management that is not all that going to go to their extreme. There are people who are just not risk takers at all. If you have those, if you get those on board, of course, it will have an impact on basically how they are going to determine. I'm mixing these points and I'm answering two questions at the same time, but just try to get where I'm separating the two. If we were talking about the optimal, then we are basically looking at a regulating point of view. But here we are just giving general points, but you can use them and explain to be able to get to what the requirement of the question is all about. Of course, we can talk about like financial flexibility. Financial flexibility. It could be flexible. You may be having debt in your capital structure, but you can convert it. It is maybe a convertible debt. You can actually convert it to equity. So the kind of flexibility of the finance that you have, is it something that you can actually, if maybe you have equity, can it be converted to debt? If you have debt, can it be converted to equity? So the level of flexibility may determine how much debt or equity you are going to have in your capital structure. The other is commitment. If you are committed to something, you can actually do it. So that's a little bit self-explanatory. There are also things to do with market conditions. What is prevailing the market? The market may be too harsh that you can't even get debt. It is too expensive, you can't afford it. So you find yourself having more of equity. So you can also talk about the availability of the resource or the present, the available sources. You may want debt, but the debt finance is very expensive for you. The other, you may talk about risk attitude. How are you able to look at the kind of risk? Are you a risk taker, a risk averse, or so whichever you are going to impact on whether you are going to be on the kind of structure, the kind of capital structure that you are going to have, or the kind of sources of finance that you are going to have in your capital structure. So that's basically what I wanted us to talk about as far as this first introductory is concerned for our topic on capital structure and dividend policy. In the next video, we want to look at the capital structure theories. Capital structure theories. We want to look at some of the theories. We want to look at what are some of these people are saying. We have the traditional theory of capital structure and others. We want to look at what are these people talking about as far as having debt in the capital structure or equity is concerned. So let's meet in the next video as we are talking about those items.